Hey everyone, it's the Geeks from the Geeks of Finance. I'm here with my partner Sean, and we are discussing negative gamma exposure. Gamma exposure, also known as GEX, is one of the best indicators that I've used to identify major market reversals before they happen. This is actually a screenshot from our gamma data graph. The morning of October 27th, you can see total gamma for the SPY was negative 2.8 billion, which is a very, very stretched negative reading for our gamma exposure levels. We knew we were near an extreme reading on our GEX intensity gauge, and this was signaling to us that a bounce was imminent and that we should cover our short positions and potentially start going long. And check out where this is on our graph. This is right here. This is October 27th, was actually the recent bottom, and look at the rally that took place from that point. On Friday, we were in extremely stretched negative gamma environment, and that was the day that the market essentially bottomed on a near-term basis. And we've seen a basically 12% rally since that point. So these stretched gamma readings are super important, and that's why it's really crucial that you understand negative gamma exposure and how these gamma exposure spectrums work. If you're unfamiliar with the topic of trading gamma in general, definitely check out our playlist. I'll put a link in the description below. The topic of negative gamma and negative GEX environments is really interesting to me because you have these sort of feedback loops which start to form where selling pressure actually forces option dealers to sell their positions, which eventually exacerbates sell-offs. And we actually see the same thing during these negative gamma rallies where buying pressure actually will force dealers to buy or cover their short positions. And so one of the main characteristics of negative gamma exposure environments is volatility expansion. When gamma flips from positive to negative, we oftentimes see a pickup in volatility across the equity markets. And so this volatility expansion is basically created by option dealers, but also big market participants who are essentially delta hedging their portfolios. They may be option portfolios, or they may be multi-strategy or multi-asset portfolios. And so they have to remain delta hedged in order to reduce their volatility exposure. In turn, this hedging creates big forces in the market. And so when we enter into these negative gamma environments, you have multiple waves of selling pressure as these big players have to sell additional underlying securities in order to maintain a delta hedge portfolio.
Great points, Anthony. One thing I wanted to ask is taking it to the current time frame. We've been in a negative gamma environment, and now we've kind of been chopping sideways. And you can see gamma flipping positive or negative almost every other day. And is there something we can share with our viewers that is a rule of thumb or something we've observed? What do you make of this when you see gamma flipping positive and negative on a daily basis?
Yeah, that's a good question. There's different periods of consolidation or turning points in the market where, price doesn't really seem to be making any big directional moves. So if you look here on this chart that I've got pulled up, over the past 10 days or so, we've seen price oscillating on the SPY right around its zero gamma level. Zero gamma is currently around the 455 level. And basically for the last 10 days, price has just been oscillating back and forth around that zero gamma level. And so this is kind of either a consolidation period or a potential turning point in the market. And that's oftentimes what you see, this tension between buyers and sellers. And oftentimes that's right around the zero gamma level. You want to talk about, I know you've been pointing this out in Discord quite a bit, this VIX VVIX correlation oftentimes precedes kind of, these negative gamma flips, and oftentimes precedes either sell-offs or rallies in the market.
Yeah, I can't even remember. It may have been only 3 or 4 years ago that I first started really looking closely at the VVIX, but it's basically the measurement of the expected future volatility for the VIX, whereas the VIX itself is supposedly a measure of the expected future volatility of the S&P 500. There's a little bit of mean reversion that goes into this expectation. So just briefly, I'll mention that the VVIX has even preceded the VIX by a couple of days, sometimes more, I mean, recently, like VVIX has been climbing since the 22nd of November, and the VIX didn't really bottom until the 24th. So there was a, kind of a 2-day head start there.
Yeah, and just to add to that, this VIX VVIX correlation, I wanted to point out during the September OPEX, we saw a big sell-off in the market. We topped in July, but chopping around between July and September. And the September OPEX was really where, the sell-off really took force. The VIX VVIX correlation, though, actually signaled at the beginning of September that a sell-off was imminent. I've got the VVIX overlaid with the VIX. VVIX is the candles. And if you just look here, Wednesday, August 30th was a basically intermediate low in the VVIX. And we saw that start rising here. The VIX just a couple of days later also actually had a double bottom, but the VVIX did not have a double bottom. A little bit of a divergence there, just signaling that volatility was picking up, and that was a good 2 to 3 weeks before the September OPEX, which really kind of cleared the deck in terms of gamma and allowed positioning to come in very negatively, which essentially had a quick 7 to 10% sell off over the coming weeks into October. And so that VIX VVIX correlation is always important to look at in terms of negative gamma, because a lot of times the VVIX will start trending up. And if you see the VIX also pick up a couple of days later, that can precede big negative gamma flips. So the third characteristic of negative gamma exposure environments is that we oftentimes will see stretched negative GEX reading being a leading indicator of the lows in the market preceding a big bounce and big price gains ahead. And so we've talked about this, in our Discord and a number of our other videos, is that you have to have some knowledge of where the gamma exposure levels are. You have to have a relational basis to say, where are we in the gamma exposure spectrum? And so we actually have a GEX intensity gauge on our dashboard. The spectrum for each security is different because the options market for each security, varies widely in size and trading. And so in order to know how stretched your negative gamma exposure is, we actually measure this on our intensity gauge. And so just for an example here, on the S&P 500, we've got a range of negative 3 billion to positive 3 billion. And so in an extremely negative gamma exposure environment, we could be all the way down to negative 2 billion or negative 3 billion. I've seen at the most extreme environments. Typically, what we see is when we reach those extreme levels, especially on the negative side, that oftentimes will signal that a big bounce potential is coming. And that goes back to the first part of the video that we were talking about, how these feedback loops can occur on both the downside and the upside because of the big market players and option dealers having to hedge their positions. And so when you get really stretched on the negative gamma side, so we would be all the way over here to the left side of our GEX intensity gauge, oftentimes we know that we are at a turning point in the market because gamma exposure is so stretched that any short covering, any buying pressure that comes into the market is going to act like a series of dominoes falling, with option dealers and other big players in the market having to start buying in this positive feedback loop, which really can occur in these deeply negative gamma exposure environments. So I hope this illustrates to you, how it works.
Yeah, thanks for going over those things, Anthony. If we were to kind of summarize everything for our viewers, how would you kind of summarize this in a way that gives people an actionable way to kind of look at how to trade this environment?
Yeah, so the first thing that we look for is the initial flip from positive to negative. And we do that by identifying the zero gamma level, which we have displayed, on our dashboard, of course, against the price action. So once we have a flip on the particular indice or stock that we're looking at, we can identify now we've entered into a negative gamma environment, and we can start looking at potential short opportunities based on various other technical indicators and data from the options market that we look at. Like I was mentioning before, we measure the gamma exposure intensity gauge to see how stretched gamma exposure is to either the downside or the upside. And we also have a GEX weighted volatility gauge, which we use to measure how expensive options are relative to the prices over the past year. That's on a GEX weighted basis. And so those two measurements help us to see when the market is overstretched either to the upside or the downside. So it kind of gives us a relative basis for entering our trades. We know once we flip into the negative gamma exposure environment, we know that, hey, most of the trades that we're going to look at are going to be to the short side. And then once we reach those really stretched levels on the GEX intensity gauge, we know this is probably a place where we want to start looking for potential longs to take advantage of dramatic reversals to the upside. One example I just want to point out that we discussed quite frequently in Discord throughout the month of September, we were looking for potential short entry point, and we got the signal during the September OPEX on Friday and Monday. We noticed that gamma flipped strongly negative across many of the indices and ETFs that we track. And that was our signal to start entering short positions. And we actually rode the move down all the way to the 410 level on SPY. So that was a good 7-8% move within just a few weeks that we were able to take advantage of. And all of that was signaled by negative gamma, the VIX VVIX correlation, which preceded the negative gamma signal, as well as measuring how stretched we were once we got down to those levels at the end of October. On top of that, we just launched our GEX Plus algorithm, which factors in gamma exposure data, as well as our proprietary momentum and volume indicators into one signal, which updates in real time directly on our dashboard. Gamma exposure, volatility levels, momentum, volume, all the data points that are necessary to really see where the big players in the market are positioned and when the momentum is shifting in our favor for a high probability trade. So if you guys are interested in checking that out, I'll put a link to our website in the description. You can sign up and you can join our community in Discord. I hope you guys found value in this video and you understand negative gamma exposure environments just a little bit better. Thanks so much, everybody, for watching. We'll see you guys in the next video.